tool, a.k.a. Mr. Valuation. It's my real pleasure to welcome everybody to our first webinar here, where we're going to try to help you unleash the real power of fast graphs. I would like to take this opportunity to introduce Professor Nathan Mauck, who's a real critical part of our team. Nathan, welcome.
Thank you.
And Colton Carnevale, who's really been instrumental in developing the tool. He runs our development team, and they've done a fabulous job bringing fast graphs to the level it currently is. But before we actually get started in there, first of all, I want to thank everybody for all the questions you've sent in. That really helps us as a team really get to understand what you need, what you want, what you're looking for, what you understand, and what you don't. So that's been something we really appreciated. I don't want to scare you all, but I've got something like 15 pages of questions. We probably won't get answering all of them, but we're going to try to answer many of them. Many of the questions, by the way, I think will be answered just routinely as we kind of go through the product and how the product works and what it's designed to do. And, we will try to answer as many questions as we possibly can. But I also want to say this is the first of what we intend to offer more seminars in the future. In today's meeting, we're going to primarily focus on the basic fast graph, the fundamentals, historical graph and the forecasting graph, because that's really the starting point of the tool. And I'd like to say a couple of things about that. But before I do, let me go ahead and share my screen and bring up the Fast Graph Fundamental Analyzer software tool.
I just want to interject one thing, everybody. If you look at the bottom of your Zoom app, you should see a Q&A button, and you guys will actually be able to ask questions live via chat, and we may or may not answer them throughout it, and then possibly have time for a Q&A session at the end of this. So whatever questions that you guys may have in addition to what you have asked us already via the registration, you can do via the Q&A tab in Zoom. But Chuck, go ahead.
All right, thanks, Colton. One of the things I want to say, I want to just kind of set the framework for what fast graphs is and what it isn't, if you will. And so if you're looking at the screen here, I've got Apple on here. One of the major advantages of fast graphs, and a lot of people ask questions about this, is the fact that it's a dynamic tool. I developed it originally many years ago because it would help me manage money for clients when I was managing portfolios. As I managed portfolios, I wanted certain pieces of information and I couldn't find it. So I ended up developing fast graphs for my own use initially, and now we've been offering it out to the public here, and we really appreciate all you subscribers getting on board. But I want to make a couple of observations and statements about what the tool is and what the tool isn't. I'm going to use the Apple computer I have on the screen here as a really quintessential example. Number one is it's a tool to think with. Okay, it's an analytical tool, and I want to make that clear. Fast graphs is designed not to dictate valuation, because it is a valuation tool, but it's designed to reveal it. And we call it a tool to think with. I like to call it the value investor's best friend, because it really does focus on valuation, but it also focuses on fundamentals first and stock price second. And that's something else that I think, subscribers need to understand. But it's a tool, okay? And we're going to talk about the orange line and the blue line and all the other features of fast graphs here as we go through this. But I also want you to understand them and what they mean and what they're designed to do and what they aren't, frankly, because I do want to make a statement. There is no such thing as a perfect metric. There is no such thing as a perfect valuation measurement. All of these things have to be thought of in terms of ranges and possibilities and probabilities and things like that. But to start out with fast graphs, I'm going to help by illustrating what I want by taking the tool apart here a little bit. I'm going to get rid of the price, and I'm going to get rid of the normal PE, and I'm also going to take dividends off the graph. And so we're going to start here by looking at the fast graph from a standpoint of the fundamentals. This is earnings per share, and I'm going to talk about other fundamentals here in a moment. The graph key really gives you the essential information you should have. Now, one of the things the tool does, in an instant, you can look at a company like Apple and recognize that this has been a powerful growth stock over time. It's been growing at over 38% a year. But that's the long-term historical graph. The fact that the tool is dynamic is critical. And one of those things is if I shorten this to 25 or to 20 years, I want you to notice the rate of return or the growth rate of this orange line, the slope of it, if you will, has dropped to 25%. If I run this again to a 12-year graph, it drops down to 14%. And what's that telling me? That's telling me Apple as a business is a powerful business that it's been, and a company that's grown as fast as it has over the long period of time is getting bigger and bigger. Here we're looking at $2.98 trillion market cap. Obviously, it's getting harder for this company to grow fast. So the first thing you want to do is basically recognize the dynamic nature of the tool and run the tool through, run every stock you look at through these different time frames. Because every time you run a different time frame, you're measuring different times and different growth rates. Looking here in September of 2005, and obviously Apple has a September fiscal year, the company's earnings grew at 333%. In September of 2016, they fell by 10%. These are different time frames here. So as you run the different time frames, you're going to get different results. And these growth rates that you're looking at are essential. Now, what's even more important dynamically, when you put price on the graph, and these are weekly closing stock prices, that you also see that the prices, kind of follow the growth rate. And it looks like it's a reasonably valued stock here when you're measuring it with a 39% growth rate. But when you change the time frame you're looking at, the growth rate changes, you get a totally different perspective. The orange box here tells you what multiple that we're valuing the stock at whatever time frame you're looking at. That is a powerful feature you don't find in a lot of sites, and I encourage everyone to take advantage of that. Another thing that you can do with fast graphs dynamically is simply run your mouse along the price line. And you see the orange little part of the pop-up here is all these different multiples that come up. Now, this line right now is being drawn at a 15 PE. If I change the time frame again, because this is the powerful growth stock, now all of a sudden, this orange line is drawn at a 23 PE, because that's what the growth rate was over this time frame. But these are valuation reference lines. They're for you to analyze them. Now, by just looking at this graph in this iteration here, I can tell you that a 23 multiple, which is what this growth rate equals to, and therefore we're using the price earnings ratio equal to the growth rate, we've drawn that. So anywhere I touch the orange line, I've got that PE drawn here. But by just observation, I can obviously recognize that here when the price was below the line, it was trading at a much lower PE. And again, these are valuation references. They're measurements. They're not dictating. They're showing you what valuation is, what it might ought to be, and what it can be. Now, some of the other things I want to add is I want to add the normal PE. And one of the questions we got was, how do you calculate the normal PE? Well, it's simply a trimmed average, and it's a trimmed average of what the market or how the market or what value the market has been valuing a stock at over any period of time. Once again, when I change time frames, over this period that I've got measured here now, which goes back obviously to 2017, the market has had a penchant to be pricing Apple at over a 21 multiple. The theoretical fair value, which is listed down here as the fair value ratio, which is your triangles, would be a 15 multiple for a company growing at 14%. That would be a theoretical formula. We'll talk about that more later on in the webinar. But this is just saying the stock market itself has been valuing it higher, but it also valued it lower here. So what you want to do is you want to use your powers of observation when you're utilizing this tool and evaluate what you're looking at so that you can think about what's happening. When I run the full value here, all these years, Apple traded at a much lower valuation than 30 times earnings, which, by the way, we cap fast growth stocks off at a 30 multiple just for, conservative reasons and for common sense. So it's a very, very dynamic tool. You can even use our slider here and go back in time and look at different time frames to see what different growth rates were and what different valuations were. So I've, utilized Apple that way. So the blue line is simply a trimmed average of how the market has valued the stock over a period of time. It doesn't mean that's the right value. That simply is trying to give you some indication of what valuation has looked like over a given period of time. This would be a theoretical fair value. The orange line will always be that. We use formulas to try to determine that, but they are references. They are not dictates, they are references. All right. So the first step in using this tool to think with is look at what you see here and observe what you see. And for example, if I take a look at a company like Charles Rivers Labs, this is a really classic example here. And I run this as a long-term graph. The orange line is theoretical fair value. The blue line is how the market has been valuing it over this time frame. That's all it means, over this time frame. And clearly, when you see the price skyrocket like this, your powers of observation should tell you this is a massively overvalued period of time. It didn't really make a lot of sense, that it could be trading up here at multiples like 40 times earnings, but it did. And of course, that led to the stock dropping. So the first thing I want, to point out, one of the questions you all asked was, what's the most underutilized part of the fast graph tool? I think two things. One is underutilizing the dynamic nature and not running a stock through these different time frames so you can get a sense of how the stock is growing. And the other thing, which we're not going to talk about a lot today, but we will in future iterations, would be the fund graphs part of the tool, because a lot of questions you asked are also answered in the fund graphs. Like fund graphs contain things like price to book. They contain metrics like enterprise value to EBITDA and so on. So it's the dynamic nature that's important. The other thing I want to point out is, what's the best metric to use? The answer is all of them. Okay, fast graphs makes it very easy for you to look at all of these iterations with just by a simple click of the mouse. So if I want to look at a stock like Coca-Cola, for example, I can look at it through earnings. I can see that the market's always put a high valuation. I can look at it through, this is operating earnings. I can look at it through diluted earnings. And one of the things I see here by observation is that there were times where, with accounting convention, non-cash charges and accelerated depreciation schedules and so on, the diluted earnings dropped a lot, but they noticed that the market didn't seem to care. So a lot of times you'll see there's not a high correlation. But if I look at cash flow, we've got two important cash flow metrics in the basic fast graph. You can look at cash flow, you start to get a lot better correlation for Coca-Cola. And if you looked at a stock like PepsiCo, for example, obviously in a very similar industry, not the same, but very similar. When you look at Pepsi through operating earnings, you see that. When you look at it through operating cash flow, you see a better correlation. So what would be a better maybe valuation metric when I'm looking at Pepsi? Rather than earnings, I might look at cash flows. Okay, I might even look at free cash flows. And even when these things don't correlate real well, they give you insights into what's happening with the company, how safe the dividend is, and so on. So that's basically my introductory remarks that I wanted to make. I'd like to now turn it over to Nathan. Nathan, is there anything you'd like to add or you'd like to talk about in addition to this?
Yeah, great overview, Chuck, and very useful. Just a little bit on, my use of this. Just as Chuck was mentioning, I really like to use this for my own investing. I also use this in the classroom. I teach a graduate level class on valuation. And the thing that I love about the Fast Graphs tool is its ability to simplify something that sometimes can be a little bit hard to wrap your head around, which is this idea of coming up with an estimate of value. And, one of the questions that folks submitted in advance was, how do I know which tools to use and when, which I think is a great question. And I've been thinking about that one a lot, and I'm just looking at the Q&A and seeing a lot of questions related to one of these aspects. But there's kind of two directions I go with that. Is one, for idea generation, the tool is very powerful. So that would be the screening functionality, and folks have questions about screening. And we're going to tackle screening in another webinar. The kind of other uses, once you already have a stock that you're interested in, the two things that I find this tool very powerful for are giving you a quick idea of the fundamentals. And so, kind of ignoring the price, ignoring how the market's valuing the stock currently, just getting a sense of what do the fundamentals look like. And, really getting a quantitative sense of what the fundamentals look like. So I think, certainly you want to form your own qualitative opinion of a company. How do they make money? What's their competitive positioning? But sometimes we can have an idea of a company, positive or negative, that isn't borne out by the facts, by the data. And so that's quickly summarized here. And then the final part is really putting the value piece in, and using the charts, just as Chuck has been shown with these reference lines that give you some idea of a bound of maybe reasonable estimates of what might be, based off of history, based off of theory, what might be kind of a reasonable valuation range based on the information that we have and the fundamentals that we have. So, that to answer the question of, which tools to use and why, screening tool is great for identifying. This historical chart is great for a quick fundamental analysis. The forecasting tool is great to get some sense of where things might be headed. Historical graph that Chuck has up now, you obviously see that light green, that's the, projected piece. Also really, really handy. And so, another question we had that came in said, what advice would you have in taking a structured a structured approach to analyzing a stock? And that really my structured approach, I'll show you here just momentarily, is really to start with the fundamentals and to try to come up with an idea of a valuation range before I've really looked at the price. So sometimes once you've seen the price, you can try to justify that valuation, right?
Yeah.
Maybe it's too high, and so you try to squint just right to make it make sense. So I would rather kind of come up with an idea, and then I put the price on and then see what it looks like. And so I'll just share my screen here and just give you a quick example of how I might go about doing this.
And
So
Nathan, while you're doing that, can I interject and ask a question? You and I've had a discussion about this a lot. When you're talking about what's the best metrics to use, most studies and academic work has been done usually on generalities, but FastGraphs focuses on the company in question. And so sometimes, there's one metric is great for one company and not for the other. Like you and I've talked about Amazon a lot. You might want to cover that here.
Yeah, absolutely. And, I would say actually one of the group of questions that folks submitted in advance that had the most interest on the valuation side is which ratios to use and when. What about price to sales? What about price to earnings? What about EBITDA measures? And the unsatisfactory answer I have to give is it depends, right? That it's really going to depend on the context of every situation. Actually, some people's questions really spoke to that of, which ratios are best for growth companies, which are best for these types of companies. And the answer is, of course, it really does depend on the context. And I'll do a couple examples here to give some just a real practical example of how I approach this. But ultimately, as a professor, maybe not surprising that I'm interested in the theoretical part, but ultimately I'm a pragmatist. So my main question is, does it work or not, is the best answer to those questions. And that's kind of what the historical graph can tell you is, does this metric contain anything that looks to be useful? Does it help you make decisions? Does it help you think? Or is it just kind of noisy and messy and doesn't add anything, in which case you might want to move on to another metric. So I was talking about this previously, but if you move down here, you can click on any of these items to add or remove them. But I like to take the price line off. And so again, this orange line is a theoretical line. The blue line is based on history. I really like that both of these are available because the blue line is really market determined. This is what the market has valued Apple at historically. The orange line is a theoretical idea of what a fair value might be based off of the work of Ben Graham and others on sort of appropriate fair value multiples. And so you can kind of think of, and some people even ask, hey, sometimes the blue line's above the orange line, sometimes it's below, sometimes they're really far apart, sometimes they're close together. How do you know which one to use and when? They're just two different perspectives on a potential multiple that might have something useful information to us. And so I like to think of it as something in between those two lines maybe makes sense. Something maybe below both those lines would maybe look undervalued, at least on the surface, before we did any more digging. Anything above looks maybe a little overvalued. So you know, again, that kind of gives us a range of, you know, prices of values for Apple at this particular time. So maybe from 160 to about, you know, 180, 190, somewhere in that range. And you pop the price line on, and that's about where it's at. It's at the kind of upper range of this orange line. As Chuck mentioned, this is a dynamic graph, so that's based off the full time period. If we shrink this down to 13 years, it changes the answer quite a bit, right? Because both the orange line and the blue line have come down. Now the blue line's ahead of the orange line, and that's because the growth rate changed over this period of time. So if you look over the full period that the Fast Graphs has for Apple, very high growth rate, so very high multiple, lower growth rate here, so lower multiple. And, you know, Apple looks to be a bit above that line. Going back to the fundamental question is real quickly, as Chuck already mentioned, I mean, the thing that's very obvious, Apple's been an incredible earnings generator, right? So just as a fundamental, how have they done producing earnings really well? It's almost a 40% growth rate over this period. That's incredible. Even over like the last 13 years at 14%, last 9 years at 14%. For a company of that size to hit double-digit growth rates is impressive. So this is like a real quick fundamental check. So to get to this question of, you know, different ratios, I'll go to one of my favorites for this because it's going to look ugly, which is Amazon. And so, you know, Amazon, you know, very, very low earnings for most of this. So this graph sort of looks not as, you know, pretty as the Apple graph does. You know, don't have that just big green chunk on the bottom. So again, the main way I approach this question of which ratio do you use is to some extent, there doesn't seem to really maybe be, you know, you can put the price line on here. The price line, you know, certainly tracks, you know, earnings at least somewhat, but I'm not sure how, you know, overall helpful that is to me. So if I look at like something like operating cash flow for Amazon, well, now the black line, the price line, has tracked the kind of orange and blue lines fairly closely over time, over the history of this stock. So something like an operating cash flow for Amazon seems to, at least in the past, have explained things a little bit better. Amazon's another one of these companies we got to be a little bit mindful of the time horizon. If we chunk this down, you know, a little bit more, we get a little bit of even cleaner picture. And so, you know, this gives you some idea again of where maybe Amazon could go if they hit analyst expectations and if they continue to trade at these multiples that they have historically and continue to grow at those rates. And maybe one final thought that a lot of folks had is things like, how do you adjust for, you know, return on capital, or how do you adjust these multiples for interest rates, et cetera? You know, my most fundamental answer is the two things that kind of theoretically drive valuation multiples are growth rates and risk of a firm. And so risk, you could also kind of include like quality, some sort of measures like, you know, margins and return on blank, you know, whatever your favorite return on measure is that measure sort of quality, performance. But, you know, the higher the growth a company is, the higher the multiple, and the lower the risk of the company, the higher the multiple that you would expect. And so just generally speaking, that's usually why you see differences in ratios. You know, somebody asked about more macro conditions like interest rates. Interest rates can influence just overall sort of the relative appeal of stocks, right? Relative to, you know, no risk type of investments or very low risk types of investments that you can get on interest bearing type of investments. So generally the thinking is higher interest rates would mean lower multiples kind of across the board. There's been a fair amount of research on this. Interest rates are not one of the main drivers of multiples. I would certainly say that they seem to matter. but interest rates are not the main thing that drives multiples. The main thing that drives multiples is growth, the generation of cash from the firms and from the market more generally. So just a few thoughts there, Chuck, on some of those questions.
Yeah, great. That was great, Nathan. Thanks. Now, what I would like to then move on to a little bit is just kind of take everything we've talked about so far on the fast graph historical chart. And remember, we're still focusing on the historical graphs here.
Chuck, before we move on to forecasting, if that's what you're going to do, especially.
Yeah, go ahead if you have something to say.
Yeah, we just got a question from Daryl, and I'm sorry, I'm not going to pronounce everybody's last names. I don't want to butcher it. But he asked, can you explain the light green area dividends stacked on the graph and how investors should interpret this? So I thought this would be a good time, since you're on the historical chart, to help explain that.
Sure. And as I'm going to do that by doing what I was going to do anyway. I'm going to go ahead and put that on there. You notice that I've taken it off on this graph. So the white line on the graph, the fast graph, which we haven't talked about yet, is the actual plotting of dividends. And I use this example to make a point. Number one is I can instantly look at this graph. And it's one of the advantages of fast graphs, how you can instantly look at graphs and get a perspective, as Nathan alluded to. So here I can see that this company didn't even start paying a dividend till 2012. I can see that because that's when the white line started. This whole dark green shaded area are earnings of the company cumulatively, you know, how as they've grown and how much earnings they've delivered for their shareholders. The area below this white line is the actual dividend payout ratio, what portion of these total green earnings that the company paid out. So I'm going to kind of shorten this so we get into just kind of the time frame here where Agilent has paid a dividend. Now, the first thing I see here is that by just looking at this graph and eyeballing it, I see that the payout ratio is very low. This company has a very low dividend yield, 0.72% current yield. All right. And I can see that they pay out a very small proportion. Now, if I point to these dots, it tells me what the payout ratio was, but I can also see it visually. I can also see by just looking at this graph that it's something low. Okay. If I contrast that to another company that I've got here on the graph, like a utility company like EIX, Edison International, and look at it, I get just a total opposite perspective. I see that this company pays out a lot more of earnings. So this area below the white line is how much of this total profit that they pay out. Now, the reason we stack it on top, now you don't have to have it there. Some people don't like it there. They just like to look at with the white line. But the reason I like to see it stacked on top is to make a point that from a rate of return perspective, you get the capital appreciation or depreciation in some cases by going from point A, you know, and I picked a spot here where it was in value to point B, okay? And if I draw this pop-up, that tells me what the growth was been. Over this time frame, that's been a 31% growth. But I also received dividend income, and that's what the green shaded area is illustrating here in this example. It's showing that your total return is a function of how much income, how much growth you achieve, or capital appreciation, where the price goes from point A to point B. But additionally, you're going to get that income. Okay. And this is without dividends reinvested. But one of the things you can do with fast graphs is show performance with reinvesting the dividends. Okay. So here we've got a low growth stock. It's another observation you immediately see by looking at the graph. I see a high dividend payout ratio compared to what I saw before, but I can also look at other companies on this graph and recognize that, you know, immediately that they don't pay any dividend or very little. Well, let's go to another utility before I do that. Here's Southern Company. Look at the large payout ratio. I see that immediately by looking at this graph. This company is paying out most of their profit to me as a shareholder in dividends. And that's why the light green line on here is so thick. So that's another instant observation you get with fast graphs. But I created a portfolio here called Fast Graph Tutorial, because another aspect of the graph that I want to get across to all the subscribers here watching the channel is one of the instant, and again, Nathan alluded to this, one of the most instant things you can do with fast graphs is immediately look at a company. Like here I can see I've got a low growth utility stock, 3.7%. I see the price has tracked a 15 multiple, but I also see that the valuation is high now. And I just see that. I don't argue with it. I don't try to decide why. I just simply recognize it through my powers of observation. But this is a graph that you won't be able to draw with any of you who are subscribers, but I still have an echo of it. This is the Bed Bath & Beyond graph. Instantly look at this graph and recognize that I'm looking at a company here whose earnings have deteriorated dramatically. And of course, the company ultimately went out of business. I can instantly see that with fast graphs. I look at a company like AutoZone, and I see a very fast growing company here, but immediately I see, just by looking at this graph, there's no dividend, there's no white line, and there's no light green shaded area that Cole talked about. But I also see an earnings growth rate of 16, which is what the multiple of this orange line. I see that the market has tended to value it at a slightly lower multiple, as Nathan talked about. But I also see periods when it valued it higher than that and lower than that. And I also see that the market price tends to come back and forth to those lines. It adjusts back to the mean, if you will. And I can look at AutoZone here and I can say the stock is slightly overvalued because it's slightly above the fair value line. But I also see that I get no dividend. So I've got to expect this stock to continue growing. And, you know, another perspective that I can get from that is if I look at, for example, give me a minute for it to change for me. If I look at Advanced Auto Parts, a little different than AutoZone, I see another case where the price tracked earnings. I see the dividend payout ratio is minuscule here. You know, it pays out less than 7% of their dividend. I see that they paid a special dividend here, which I can see just by observing the graph. And I can see that the price tracked this very nicely for all these years. Then all of a sudden, for whatever reason, the stock had a collapse in their operating earnings. And now we see this big drop. So as I'm using this tutorial here to point out that there's a lot of different kinds of stocks that you can look at with a tool like fast graphs. And, you know, Nathan and I have talked about companies like this. When you look at a shift for payments, sometimes one of the better metrics to use, to go back to that question, would be sales. Some of these young companies that are just starting out, you might get a better perspective by looking at them at sales. But which metric do you use? My answer is all of them. You can just instantly go through EBITDA, you know, you can go through cash flows, you can go through all these things, and you're trying to get, you know, valuation is a puzzle and investing is a puzzle. But I also want you to recognize how you can look at these stocks and just see how different they are. Here's a cyclical stock, Caterpillar, and you can see the cyclicality, the earnings rise and fall. Again, the dividend payout ratio that Colt asked about is here. It looks like it's lumpy because it's stacked on top of the earnings, but it's actually this portion of the earnings here that were being paid out in dividends. But instantly, by looking at a historical fast graph, you could see, you know, what kind of company it is, as Nathan talked about as well. You can see whether it's a growth stock, whether it's a high growth stock, whether it's a low growth stock, if it pays the dividend, how soon it started paying a dividend, how the market's been valuing the stock. Because you can look at some of my favorite stocks in the world would be a name like Visa, for example. And what do I observe? I see that the company has been extremely consistent, and it grew their earnings at, you know, over almost 19% a year. And so we're using a 18.92 multiple on this orange line, but yet the stock has traded at a 27 multiple, and it kind of started doing that since 2013. I see that, I observe that. I don't try to argue with it. This is how the market's been valuing the stock over that period of time. I see a moderate payout ratio here, you know, 18 to 20%. It's still a growth stock, has a relatively low yield. Part of it is because the dividend is so high. Now, by the way, I mean, the price is so high, so obviously that even lowers the dividend, but I can also look at historical dividend yields, and I can see when the price was fairly valued, you know, I would have, you know, a little higher dividend yield than I would when the stock was lower valued. So there's, you know, so many features to this tool that we can't cover all of those things. But one of the great things is you can instantly look at a stock and know whether or not it's a company that you want to be investing in or not. Like, for example, look at this communications company, Lumen Technologies. instantly see the graph. They had a low payout ratio. They suddenly started paying out massive amounts of their earnings in dividends, even to where they had payout ratios of over 100%. But you can see right here, you know, where they paid a $2.90 dividend. But of course, you can see that the earnings have fallen. But then when I'm looking at this stock, I can also go through operating cash flow and see how well is the dividend actually being covered. But I can also see that they've been reducing their dividend. I see these things instantly just by looking at the tool and looking at the different aspects of the tool. I can look at sales, and I can now get an idea that this company's sales have been dropping, as well as their earnings and their cash flows and all those other things. So I'm getting a sense of what kind of business that I'm actually looking at, you know, and you know, I can also see stocks that I would consider just really, you know, consistent, great stocks. Like a good example, if I knew how to type, a good example would be a stock like Elements. And this is where Fast Graphs really shines. You can see that this stock has just consistently grown earnings at double-digit rates. You can instantly see that they started paying a dividend in 2011 just by the way, point to things on Fast Graphs. I can point to the black line and run my mouse and see that the market at one point was only valuing this at 8 and 9 times earnings, even though it was growing at double-digit rates. Why? I don't know, because the market was, you know, behaving foolishly. Who knows? Then I see they started to pay a dividend, and I can observe here by looking at this graph that once they started paying a dividend, perhaps investors got a little more confident in the stock, and the earnings multiples began to expand. And now, more recently, it's been trading at about a 15 multiple very consistently. And when it deviates, it comes back, and so on. And I can see right now the stock looks fairly valued. And by the way, a 15 PE ratio, one of the questions we've gotten several times in different iterations on this was, you know, why a 15 PE? Well, you know, I've talked about this a lot in the past. Ben Graham said never pay more than 15. 15 PE is the inverse. It's an earnings yield of 6.76%. That's a minimum return that you would want a company's earnings to be able to provide you. That's, you know, 16 to 20 or 18 or 19. These numbers change when you look at different time frames, has been the average multiple that's been applied to this overall stock market as measured by the S&P historically. So, you know, we're looking for good value with margins of safety, and the orange line, in theory, already builds in a margin of safety for you. It's a minimum earnings yield that you would want to basically, you know, expect on your stock. And when it's above that, you can still make the decision. You can make a decision to buy Visa, for example, because you love the company and you think the market's been valuing it highly and it's growing like a weed. But you ought to make that decision with your eyes wide open and recognizing that you're not buying it at a very cheap valuation. You're paying a premium valuation for it. So that's some more, you know, insights into the power and the value of the historical fast graphs. You could just recognize companies and see all these different kind of companies, and, you know, how they've, you know, how the market is valued. Again, look at another cyclical like, you know, Eastman Chemical, and see that how the price tracks that and make a decision of whether or not you want to buy it or not. And I did have a question that I thought was interesting, that before I leave this, and I'm going to let Nathan and maybe Colton see if they want to add anything, but one of the questions was, I looked at Siri, and, you know, the price has now fallen below the orange line. Does that mean it's undervalued? Well, let's look at Sirius XM Holdings, you know, the music company. Well, it didn't make any money back here. I see that. The stock came out with an IPO, was highly valued. And then, you know, and you can measure performance on fast graphs by just simply clicking the stock price from any price to any other price or any other plottable point on the graph, and see what performance was. And here you'd have lost, you know, an annualized loss of 45%. Then the company started making money. The market liked it a little better. You know, these multiples have been crazy. So I see a very inconsistent company. But again, as I shorten the time frame, I get a better perspective. So now the price is below the orange line. Okay, so that would indicate it's fairly valued. It has an earnings yield of over 12%. That's close to double the minimum that a 15 PE would represent. But the question is, how much growth does it have going forward? And is it going to return to the blue line or the orange line? You still have to make those decisions for yourselves. We're revealing valuation. We're not dictating it to you. So Nathan and Colt, anything to add more on the historical graphs before we do move on to forecasting?
Yes, we have one question from Oscar, and that is, what is EPS yield and what is its importance?
Oh, the earnings yield, sure. What the earnings yield is it tells you if you owned 100% of a business. And let's put something, the series a little bit of a bad one here. Let's put something up here like let me put the old Amerisource Bergen, which is a real consistent Cencora now it's called. It's a real consistent company. All right, so the PE ratio is the price divided by earnings. We all know that. Okay, but the inverse is the EPS or the earnings yield. Okay, and what that simply says to you in real simple terms is if you own this company, let's get price off the graph here. If you were a shareholder in this company, or you are 100% owner, excuse me, of this company, and this company did not just pay you a payout ratio of 16%, if they paid you out 100% of all the profits they earned, your yield, just like a dividend yield, would be 5.63%, because right now the price is trading up here at a PE ratio of 17.76. So the earnings yield, rather than the price divided by the earnings, it's the earnings divided by the price. And it's telling you what your rate of return would be, similar to a dividend yield, where you're seeing a payout ratio if the company paid out 100% of all their profits. So when you're seeing real low earnings yields, it ought to tell you, is this investment really worth taking the risk if I'm only getting a 3 or 4% return if I owned 100% of the company and they gave me 100% of their profits? And that's why I think earnings yield, and by the way, that's another reason why a 6.5 to 7%, which is the inverse of the 15 PE. So if you divide, the earnings by the price, if you will, that gives you the earnings yield. And that tells you, it's a great valuation metric. And again, a minimum number should be 6.5 or 7%. If I can get more than that, I'm very, very delighted. Anything else? Nathan, you want to add anything?
Yeah, I love the earnings yield as a measure. And Chuck, I know one thing you and I have talked about a lot too, is, the earnings yield you see here is, and as of right now. And when a company grows earnings, if you buy now and the earnings grow, that earnings yield in the future actually goes up, right? Because the earnings will go up, but the price that you bought at stays the same. Now, the market price, is another story. What happens to the price? There'll be a new earnings yield every time the price changes and every time the earnings change. But that means sometimes you could buy something that maybe had a current earnings yield that wasn't super attractive, but might grow into something more attractive. So for higher growth stocks, sometimes that current earnings yield is a little on the low side, and but might be projected to go higher.
Colt, do you have anything you want to add?
Nope, nothing to that. I think one thing I do want to maybe take a look at now is the forecasting.
Yeah. So great, thank you. So the way I use fast graphs is I immediately look at the historical graph, as we already iterated several times here, so I can determine what kind of company I'm looking at. What is the nature of the beast? Is it a cyclical company? Is it a high growth company? A low growth company? Have earnings been on the wane? Have they been dropping? Have they been rising? So I have that perspective. But before I buy a stock, okay, before I'm actually interested in buying a stock, I'm going to look at what the future is, because I can learn from the past. And I say this all the time in my videos and so on. I can learn a great deal from looking at the past, but I can only invest in the future. I can't buy any of this past because it's already gone. All right. So what we've created with these forecasting. Now we give you some forecasting data on the historical graphs, and we just give you what the estimate earnings are. You can see that by it's marked with a capital E here. If there's no capital E, then it's an actual number. So everything from, that's behind this light green shaded area, pardon me, this is all factual. Okay. Everything you see in this light green shaded area is forecast, and it's an estimate, and that's critical. So we've developed these forecasting tools. Now we have basically 5 different forecasting calculators. You have one that's based on estimates where you're drawing the orange line. So it's based on the orange line, if you will. And the first thing I want you to note is that it's how many analysts are in the universe. So this is the consensus estimate. Now notice the 2023 number here is an actual, and there were 19 analysts that made it. I also want you to note that you can look at this and see that 6 months ago, analysts were estimating 3280. Then the estimate went to 3291. Then it went to 3305, and it came in at 3314. So, by looking at past here, again, still staying on the past, I can see that analysts have been getting more and more sanguine or more and more optimistic, if you will, about this stock, and it actually beat even the most recent estimate. Now for 2024, the estimate 6 months ago was 3705. There are 20 analysts in this universe, and we get this data from FactSet, and they're gathering the consensus estimates of leading analysts that are following the company. And we see it was 3705, 3715. Again, estimates are going up. The estimate sits now at 3727, which has been the most recent estimate. Now, by the way, as a sidebar, one of the questions we get is how soon do we update these estimates? Immediately. As soon as FactSet gets the data, we're running, how often are we loading data, Colt?
It's all throughout the day. So yeah, I mean, as soon as we get the data from FactSet, we update it. Pricing all tends to come in obviously at the end of the day since we're using end of day pricing. But fundamentals and estimates, that just comes in throughout the day, and whenever we get it, we load it.
Yeah, so it's, it could be maybe up to 24 hours depending on when it came in, where we were in the loading process, but we're basically getting the data to you, any changes in these estimates as quickly as we possibly can as they happen. The other thing I want you to note on here is that, again, you've got the same thing going for 2025 and 2026. The only difference between the estimate tab and the normal multiple tab is that we used the normal PE ratio, that average multiple that the market has been applying. And you've got this nice drop down here, which you can review how all throughout the historical graph, what the normal multiples have been. So you can see on Elevance here that a 13 or 14 multiple has been very common for this company. And then more recently, as I pointed out, as they started paying a dividend, the multiples have actually increased to 15, 16, et cetera. And then what this defaults to is the last 5 year. Now, not with no historical data, you would have to scroll out the forecasting data I showed you on the historical graph to get this number. But the 5-year normal PE has been 16. So now you can measure that. And how you use these are, you go to the estimate tab and you say, if the company's earnings grew as the analysts expected, you could point to any one of these time frames. There's a 15 multiple that would tell you what your annualized rate of return, including dividends, would be. Okay, this parallel lines here are different multiples. If the stock traded at a higher multiple out here, say of 22 times earnings, then you would stand to make 30% a year. If the market really shrunk and only put a 7 multiple, 7.5 multiple, you would actually lose money on the stock. So these are what if scenarios. What if these earnings happen? What if these estimates are correct? But I never used a forecasting graph without simultaneously scrolling down into the analyst scorecard, because the analyst scorecard now gives you insights into how accurate the analysts have been. Now, one of the common questions and complaints, or, I get from, people is that, you rely too much on analyst estimates. One of the questions we had in the list here is FastGraph forward looking or backward looking? And the answer is it's both. And it does an incredible job with both of those things. We can look at the history and we can look at it through all these machinations that we talked about. And keep in mind, when you go to most sites, they focus on price, as Nathan and I both have pointed out, and Colt, this is a focus on fundamentals first. All right. But the point is, I checked the estimates. Now, on this particular company, this company has either beat or hit estimates 100% of the time. There's no misses, I want you to notice. So what does that tell me? That tells me that this company, and by looking at the historical graph, I can even logically see that's been a very consistent grower. Okay, but I'm also seeing now that the analysts have been, very accurate. Now, analysts get a lot of their information from guidance. And so we're measuring how accurate the analysts were when they made the estimate 1 year in advance, okay, with a 10% margin of error. To believe that these analysts are going to be perfect would be naive. And then as we go further out, we give them a little higher margin error. We give them a 20% margin of error when the analysts were making an estimate 2 years forward. Okay, but so I can look at a stock like Elements and I can say I have a high degree of confidence that these numbers are probably going to be well within a range. And you can see that here, that, the estimates have always come in well within a reasonable range of what within these margins of error that the analysts were expecting. Now, if I would happen to go into a very cyclical, actually low growth or no growth company like US Steel and look at their past track record, I can see instantly by looking at US Steel, as I talked about earlier, the company's earnings grew like crazy, then they collapsed and they lost money for several years, earnings up and earnings down, stock price has gone nowhere, earnings have gone nowhere. When I go to the forecasting calculators here, and I'm looking at what the analysts are forecasting going forward, I also learned that analysts are wrong about half the time. Half the time they beat it, and half the time they miss it. So my confidence level in whether or not these analysts are accurate or not is going to be much lower than it was on a stock like Elements. If I look at a stock like Johnson & Johnson, one of the few AAA rated companies on the planet, and analysts are saying 4.5% going forward. If I look at their history, I see very consistent earnings. I do see the market has a tendency to price a premium multiple on this AAA rated company. But when I look at the forecasting calculator here and I go down and look at the analyst estimates, they've been almost perfect. They hit estimates almost perfectly. They did miss 8% of the time on the 1 year forecast, but that really includes COVID and even the last couple of years. But the 2 year forward estimates have been 100% on the money. So again, I would look at the estimates on Johnson & Johnson and I would say, I think I can trust these estimates. On a lesser company, I might have a totally different opinion, but I don't make general decisions about whether analyst estimates are good or not. I make them specifically on every company I'm analyzing based on the scorecard that those analysts had. And by the way, it's a starting point. Okay, you still want to go into external links. You want to go into the company's corporate website. I subscribe to Morningstar. I could go into Morningstar and, immediately bring up what the analysts, what Morningstar felt, about the company as I can read their research data, and I can do this with, other sites, Seeking Alpha. I can do this with Google and Yahoo Finance, and I can go in there and learn, more. So, fast graphs represent the first step. But the question is, do I even want to waste my time with Johnson & Johnson? Well, it's AAA rated, very high quality, low debt. Interest rates aren't going to affect it very much. And, I can get decent rates of return if everything goes according to what the analysts are forecasting. But the beauty of it is I can have a lot of confidence that those forecasts are probably close to being accurate. So, you want to use the forecasting graphs in association with the analyst scorecard, because you want to know whether you can rely on them or not. Now, these first two estimates, the normal multiple or the regular estimates, are based on the same numbers. The long-term growth rate estimate is a long-term growth rate. And just to give you an illustration, if I went in here to Yahoo estimates, okay, just looking at a different source, and I went into analysis here, I could scroll down and I would see this is a different set of estimates from a different set of analysts that are covered by Yahoo. I think they get theirs from Reuters, Colton. Nathan, I don't know if you guys know, but here they give the next year's estimate, they give the next 5 years of 5.2%. Now, if I go back to the fast graphs, we're given 3.97 with only 3 analysts in the universe. Different estimates, but 3 to 5% might be a reasonable expectation for this company as a long-term growth rate. Now, you can go into the custom calculator, by the way, and I could put in the 5% that I saw at Yahoo, and I could draw. Now, right now, I've got 3.97 or 4%. So I would get a 7% rate of return expectation. If I drew it at the 5% that the Yahoo analyst said, I would get a number of 8.3%. So I can do my own work. I can even apply my own dividends. I can apply my own growth rates. And by the way, by clicking one of these boxes, I can combine the near-term estimates, which come from these two tabs, with the long-term estimate and get maybe a better picture. The closer you are when you're dealing with estimates, one of my arguments would be the more likely you are to be correct. I trust this number, in other words, more than I do this number. But again, this is just an idea. The analysts expect this company to do something powerful. And by the way, because I was asked about this stock and what would be the good metric to use for NVIDIA, which is obviously the hot AI stock. So let's do this real quickly. We can see that, earnings growth wasn't much in the back years. As I shorten the time frame, you get a little more detail. You can see that. But what you clearly see on this graph is we've had this earnings acceleration, obviously with AI. If I draw this as a real short graph, I get this enormous growth rate here. Now, if I go into the forecasting graph on NVIDIA, the company's expected it to grow at 37%. The valuation is very high if it only achieved 37%. But, that would still give me a positive rate of return. If I use the normal multiple of a 45 or 50 PE, I could still make a lot of money because of the power of compounding here that would be associated with a company like this. Now, if I look at long-term growth, the analysts expect this company to grow earnings at 51% compounded. That's a huge number. That's almost a huge, unbelievable number. But I've said this many times in videos. You can't overpay for a powerful growth stock if it delivers you the growth. Okay. And here you would earn 28% a year. So are you overpaying for NVIDIA today? I would say you are. Can you make money buying it today? I would say you could, assuming the company continues to grow as fast as it has. All right, we've gone on here for almost an hour, and we've covered the historical and forecasting. I want to just point out to everybody now, there's so many other parts of fast graphs that we're going to be covering. Full, complete financial statements, the fund graphs, which are an unsung hero. And by the way, you can find many of the questions I got. You can find price to book, enterprise value to EBITDA. You can find all types of other rates of, returns on equity, returns on capital, profit margins in the fund graphs and health checks. And then there's also the powerful portfolio feature that we've just recently launched and developed, where you can track how much dividends you're getting in income. But all of that will be for future, webinars that we plan on doing. But anyway, I hope everybody enjoyed that. I want to take this opportunity again to thank everybody for coming here. This is a tool to think with. It's a tool. If you use it correctly, it's like any tool. If you use it correctly, it can help you make smarter, more prudent long-term investment decisions than anything I've ever seen. I like to use this analogy that, if you were sitting here in my room across the table from you, had an appendicitis attack, and I had a surgeon's scalpel in my hand, and you laid on the desk and say, "Take out my appendix." Well, you're a fool, and I've got a lethal weapon in my hand. Okay. But if you were a skilled surgeon who'd done thousands of appendectomies, then I've got a life-saving device in my hand. And so it's like any tool. It needs to be used correctly to be of value, but this tool has the potential to be of enormous value to it. Nathan, anything that you'd like to close with?
No, great overview. The one thing that I see in the questions throughout is folks saying, I kind of feel like I might not be using the tool right because I made an investment that didn't work out or things didn't go as planned. And Chuck, I'm sure you've had this experience. Like you're going to take some punches to the gut in this game, and not everything's within your control. So this tool helps you evaluate a lot of what ifs. But still, some things don't go. Sometimes things don't go as planned. They don't go as the analyst planned. But this tool helps you reduce your risk and at least have some sense of what if. What if it misses? What if the company doesn't do as well as expected? What if that valuation ratio doesn't hold? So it allows you to kind of stress test your ideas to get some idea, because things will go wrong with these companies. Sometimes they'll surprise to the good, sometimes to the bad, but you kind of want to consider all the options, and that's possible with this tool.
And the tool, if you're a subscriber, as all of you are, or at least most of you are, you can keep up with those things as they're happening. It might not get you out at the top or get you in at the bottom, but it can protect you from taking excessive losses and help you avoid obvious mistakes. Did I cut you off, Nathan, or were you finished?
No, that was it. Yeah, that's a great point. Yeah.
Colt, one of several of the questions we got here were things about when are we going to get ETFs, when are we going to get brokered stuff. You want to just make any comments on what the development team has in store for the subscribers?
Yeah, I've answered some of them via the chat. ETFs, we are, that's on the list of priorities, but I don't have a date for when we would be getting ETFs into the system. But brokerages, so we are currently working on connecting brokerages to fast graphs. There's going to be somewhat limited support on it. We're not going to cover every brokerage on the entire planet, but the company that we are working with is called Snap Trade. And they cover pretty much all of the major ones, right? So Schwab's, Robinhood's, blah, blah, blah. So we're working on getting that in, and we hope to release that feature here in the upcoming future. And then like within the next few weeks is what I mean. And then just so everybody knows, we actually do not receive your login credentials or anything like that to your brokerage accounts. That is maintained, securely via Snap Trade. That never hits our system, so there's no potential, data leak from our system at all. But yeah, so stay tuned on that. That should be coming out in the next few weeks. We are in our final stages of testing for brokerage connections to portfolios.
All right, anything else? Anybody want to add anything, any final words?
Yeah, and then the only other thing that I want to add, we've had a lot of questions on here that we weren't able to answer, some things regarding screening and whatnot. So everybody, I definitely suggest you guys kind of stay tuned and keep your eyes open for invites and whatnot to future webinars where we're going to cover, as Chuck said, other parts of the app. We'll go more into depth into portfolios. We'll take a look at fund graphs. We'll definitely do some big screening tutorials and things like that. We're also working on a new screening tool, which I don't have any announcement in terms of when that will be released yet, but it'll actually allow you to compare metrics to other metrics. So one of them is going, like an example would be you'll be able to write a query that says the current PE is less than the 5-year normal PE. And that'll let you screen for stocks like that. So it'll be that and just an easier query builder and whatnot. So keep your eyes and ears open for future updates of the tool. We're always working on it, always releasing new ones, and keep your eyes open for future webinar invites.
Yeah, and I'll just close by, there were several questions like, how can I tell if it outperformed or performed with the S&P easily? Just click our performance tab here and it compares with the S&P, but you can also compare it against other companies. Like you could compare Microsoft and Google, for example, and again against the S&P. And again, there's so much more to this tool, and we're very proud of it, and we're working very hard to make it a better tool for you. And by the way, I want to thank you all again for joining. I also want to thank everybody for their questions. I wish we could have answered them all. I'd be willing to go here till midnight, but I don't think many of my colleagues would, or probably most of you wouldn't. But the point is, there's a lot to this tool. We're going to be doing these webinars because, your questions help us figure out how to serve you better. And that's our goal at Fast Graphs. Our goal is to never quit. We're going to continuously try to improve this tool and make it better, and so that you can become better, more profitable, more prudent, and safer long-term investors. So I want to thank everybody for joining. I want to thank Nathan and Colt for their participation. I want to thank my development team for the incredible work they've done on developing. I always talk about being the co-founder, but if you'd have seen the first Fast Graphs that Julie and I were building some 20 some years ago compared to what we got now, it would be it would be really funny. But anyway, thanks everybody. We're going to take our leave now. We appreciate your coming. We look forward to talking to you again in the very near future. Thanks.
Thanks, everybody.
Thanks all.